Today we're doing a complete breakdown of AASB 136. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying AASB, prepping for a Big Four interview, or working in finance, this is everything you need to know. Imagine buying a business only to discover that its assets are overvalued by 20%. Before AASB 136, inflated asset values plagued financial statements, misleading investors and lenders. By the end of this section, you'll understand how AASB 136 combats this issue and ensures transparency in asset valuation, protecting stakeholders from financial surprises. AASB 136 exists to tackle the issue of overvalued assets on financial statements. It was introduced to harmonize with international frameworks, allowing comparisons across global markets. Major financial scandals highlighted the need for transparency, prompting this standard. By requiring regular asset value assessments, AASB 136 ensures financial reports reflect true economic conditions, protecting investors from misleading information. AASB 136 is mandatory for all entities in Australia with reporting duties, effective since mid-2004. Its cornerstone requirement is the annual impairment test, ensuring asset values don't surpass their recoverable amounts. This rule is crucial for maintaining accurate financial statements. By enforcing this, AASB 136 safeguards stakeholders from inaccuracies that could lead to poor financial decisions, aligning Australian standards with international practices for consistency. The impairment testing model under AASB 136 ensures assets aren't valued above their recoverable amounts. This involves assessing whether an asset's book value exceeds its fair market value, adjusted for disposal costs. Recognizing when an asset's value drops is crucial, affecting balance sheets and financial decisions. In interviews, understanding this model showcases your grasp of financial accuracy and prudence, reflecting your ability to protect stakeholders from overvalued assets. Scope matters because misplacing items can lead to significant errors. Candidates forget that deferred tax assets are not covered by AASB 136, and that's a classic interview trap. Knowing what's in or out ensures compliance and avoids costly mistakes. AASB 136 covers assets like property, plant, and equipment, intangible assets such as patents, and goodwill from acquisitions. Imagine a tech company with $10 million in patents and $5 million in goodwill. These are subject to impairment testing under this standard. AASB 136 explicitly excludes inventories, financial assets, and deferred tax assets. These exclusions are common traps during interviews. Deferred tax assets are governed by AASB 112. For instance, a company's $2 million in inventories isn't considered here, avoiding this common mistake. Impairment is when an asset's carrying amount is higher than its recoverable amount, signaling a value drop. Consider a manufacturing plant facing $1 million in impairment due to stricter environmental regulations. Recognizing this loss ensures financial statements reflect true asset value. The recoverable amount is crucial. It's the higher of an asset's fair value less costs to sell or its value in use. Imagine a retail store with a $2 million value in use, which exceeds its fair value. This prevents undervaluing assets like a $500,000 discrepancy in assessment. Consider these tricky scenarios. Leased assets generating cash are included in AASB 136, but service concession arrangements are not, as they're under AASB 1059. Joint ventures assets, though, are covered if they form cash-generating units. Research and development costs, however, are guided by AASB 138, not AASB 136. These nuances can trip up even seasoned professionals. Imagine owning assets that appear valuable on paper but yield no returns. The impairment testing model prevents this by scrutinizing asset values, safeguarding financial statements' integrity. AASB 136 empowers businesses to identify and address overvalued assets, maintaining transparency and accountability. The impairment testing model is the backbone of AASB 136. It scrutinizes asset values by comparing carrying and recoverable amounts, ensuring they reflect economic reality. We'll follow Meridian Corporation's $10 million SaaS contract, which includes an $8 million software license and $2 million for implementation services, through each step of this process. This example will demonstrate how the model systematically addresses potential asset overvaluation to maintain financial statement accuracy. Identifying CGUs is crucial for impairment testing. It involves pinpointing the smallest asset group generating independent cash inflows. For Meridian Corporation, the $10 million SaaS contract is a CGU, as it directly generates cash separately from other operations. A common mistake is to consider entire operations as a CGU, missing distinct cash flows. AASB mandates CGUs remain the smallest units, ensuring precise impairment testing. Moving forward, we'll assess the recoverable amount of this CGU. Determining the recoverable amount ensures assets aren't overstated on the balance sheet. It's the higher of fair value less costs of disposal and value in use. For Meridian Corporation CGU, calculate both to find the recoverable amount, considering future cash flows and disposal costs. Many overlook these costs, inflating values. AASB mandates comparing fair value and value in use accurately. This step reveals the CGU's true economic value, setting the stage for a carrying amount comparison. This step involves comparing the recoverable amount to the carrying amount to spot asset impairment. For Meridian Corporation, we juxtapose the recoverable amount against the $10 million carrying value of their SaaS contract. Many fail by not updating carrying values, skewing comparisons. AASB mandates recognizing impairment if the recoverable value is less than the carrying one. This check is vital to ensure financial statements reflect assets' true value. If impaired, we move to recognize this loss. Recognizing impairment loss is a critical step when the recoverable amount falls short of the carrying value. For Meridian Corporation, a recoverable amount of $8 million means a $2 million impairment loss on their SaaS contract. Many mishandle this by not attributing losses to specific assets, compromising accuracy. AASB demands immediate recognition of these losses to ensure the financial statement's reliability. This loss recognition is essential for asset allocation, which we'll address next. Allocating impairment loss involves distributing it among the assets within the CGU. For Meridian Corporation, the $2 million loss is proportionally split between the software license and implementation services. Errors often stem from improper allocation, causing financial inaccuracies. AASB insists on allocation based on asset carrying amounts before impairment, keeping the process fair and transparent. Through this precise allocation, the financial statements accurately reflect the economic value of each asset, concluding our model's journey. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. AASB 136 requires precise measurement of impairment losses to ensure that assets are not carried at more than their recoverable amount. Get this right to maintain accuracy and transparency. Initial recognition of impairment involves comparing an asset's carrying amount with its recoverable amount. When the carrying amount exceeds recoverable amount, an impairment loss is recognized. This prevents assets from being overstated on the balance sheet. Regular testing, typically at the end of the reporting period, ensures ongoing accuracy. Indicators such as market declines or negative economic shifts can trigger earlier tests, protecting stakeholders from inflated asset values. Subsequent measurement focuses on reevaluating asset values when circumstances change. If an impairment loss is identified, assets are remeasured to their recoverable amount. Changes like economic shifts can trigger these retests. Importantly, if asset values recover, impairment losses can be reversed, but only up to the depreciated cost had there been no impairment. This ensures that assets are neither overstated nor understated, maintaining financial integrity. Clear presentation of impairment losses is crucial for financial transparency. On the profit and loss, these losses appear as a distinct line item, reflecting their impact on profitability. Adjusted carrying amounts are shown on the balance sheet, ensuring asset values are accurate. Notes to the financial statements should detail the assumptions used in determining recoverable amounts, providing stakeholders with insight into the valuation process. Additionally, disclosing affected segments enhances transparency and aids in thorough analysis. Disclosure in AASB 136 centers on transparency. Key assumptions used for calculating recoverable amounts must be disclosed, offering investors clarity on valuation methods. Sensitivity analysis is crucial, as it reveals how changes in assumptions affect impairment outcomes. Clearly stating the nature and extent of recognized or reversed impairment losses ensures stakeholders understand their financial impact. Lastly, identifying affected cash-generating units aligns with segment reporting, enhancing the clarity of financial statements. Imagine a CFO facing a $10 million impairment on machinery, triggered by rapid technological advances. The asset's carrying amount drops from $25 million to $15 million, reflecting its true value. Detailed disclosures on assumptions and cash flow impacts are shared in financial notes. Engaging stakeholders with clear communication about these changes preserves trust and transparency. This proactive approach ensures that financial statements remain reliable and accurate. Meridian Corporation, a global manufacturing company, signs a 5-year operating lease for its Singapore warehouse. Watch how every accounting event plays out. Meridian Corporation recognizes an impairment loss when the carrying amount of its Singapore warehouse exceeds the recoverable amount, per AASB 136. This entry ensures that the asset is not overstated on the balance sheet. Impairment losses reflect diminished economic benefits and ensure the financial statements present a realistic picture of asset values. To spread the impact of the impairment over the lease term, Meridian Corporation amortizes $100,000 annually. AASB 136 requires that impairment losses be allocated systematically. This amortization reflects a more accurate expense recognition, impacting the income statement by spreading the financial burden across periods. Meridian Corporation reverses part of the impairment loss as the asset's recoverable amount improves, per AASB 136 guidelines. This reversal boosts the income statement, reflecting the regained value. The financials now align more closely with actual asset conditions, enhancing accuracy and investor confidence. AASB 136 mandates regular impairment assessments to ensure asset values remain accurate. Meridian Corporation incurs $15,000 for such a test, verifying that the warehouse's carrying amount aligns with current market conditions. These tests safeguard against asset overvaluation, protecting the integrity of the financial statements and investor decision-making. Ensuring clean financial records at lease end, Meridian Corporation adjusts for any remaining impairment and amortization balances. This mirrors AASB 136's emphasis on accurate, up-to-date asset valuations. The final adjustment aligns reported asset values with true economic conditions, readying the books for any subsequent transactions or disclosures. With the lease ending, Meridian Corporation de-recognizes the warehouse asset, following AASB 136's procedure for asset removal. This entry eliminates the asset and its accumulated depreciation and impairment from the balance sheet. It ensures accurate accounting as the company transitions out of the lease, preparing for future ventures. Every Big Four and investment bank interview on AASB 136 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. The recoverable amount is the higher of an asset's fair value less costs of disposal and its value in use. This concept prevents overstating assets on the balance sheet. Under AASB 136, calculating it ensures that impaired assets reflect their realistic economic value. A common mistake is confusing it with carrying amount. Always remember, recoverable amount represents maximum value recoverable from the asset. AASB 136 mandates impairment testing to prevent asset overstatement and ensure financial statements reflect true economic conditions. Impairment testing identifies when an asset's carrying amount exceeds its recoverable amount. This protects stakeholders from misleading financial information. A common pitfall in interviews is not linking this to financial transparency. Remember, impairment testing enhances reliability and accuracy of financial reporting. Under AASB 136, an impairment loss is recorded when an asset's carrying amount exceeds its recoverable amount. The loss is recognized in the profit and loss statement, reducing both the asset's carrying amount and equity. A common error is failing to adjust the asset's depreciation schedule post-impairment. Key takeaway: record impairment losses promptly to reflect asset devaluation accurately. Impairment testing under AASB 136 is required annually for intangible assets with indefinite useful lives and goodwill. For other assets, it's necessary when indicators of impairment exist. This ensures timely recognition of asset impairments. Interview trap, overlooking indicators such as market decline or legal changes. Remember, proactive testing prevents financial misstatements. A cash-generating unit is the smallest identifiable group of assets generating cash inflows, largely independent from other assets. This unit is crucial for impairment testing. AASB 136 requires allocation of goodwill to these units. Common mistake, confusing cash inflows with profit. Always link the unit to cash inflow independence for accurate impairment assessments. Indian accounting standard aligns closely with international financial reporting standards, but differences exist in terminology and specific disclosure requirements. For example, Indian Accounting Standard 36 emphasizes recoverable amounts, similar to international financial reporting standards, but local adaptations may affect certain calculation nuances. A classic interview pitfall is ignoring local adaptations. In interviews, highlight understanding of both standards' core similarities and differences. When carrying amount exceeds recoverable amount by $20,000, an impairment loss must be recorded. Debit impairment loss and credit equipment for $20,000. This entry adjusts the asset's book value. Avoid the trap of reversing debit and credit. Memorize. Always reduce asset value to match recoverable amount. To comply with AASB 136. Inventory is excluded from AASB 136 as it falls under AASB 102, which focuses on inventory valuation. The confusion arises because both standards involve asset valuation. Remember, AASB 136 targets non-current assets like goodwill. Clarity on scope ensures correct application of standards, avoiding misclassification and inaccuracies in financial reporting. A CFO must disclose impairment testing methodology, assumptions used, and reasons for impairment loss. This includes detailing cash-generating unit allocations and recoverable amount calculations. The challenge lies in providing transparent insights without revealing competitive data. A common oversight, omitting sensitivity analysis. Always ensure disclosures offer comprehensive context for the financial community. Confusing carrying amount with recoverable amount can lead to incorrect impairment decisions. The carrying amount is the book value on the balance sheet, whereas the recoverable amount is the maximum achievable value. AASB 136 mandates impairment when carrying exceeds recoverable amount. Avoid this trap. Differentiate clearly to ensure accurate financial reporting. AASB 136 ensures assets aren't overvalued on balance sheets. It applies broadly, excluding only inventories, deferred tax, and financial assets. The recoverable amount is key, defined as the higher of fair value less cost to sell or value in use. Impairment losses arise when carrying values exceed this. Assets are grouped into cash-generating units, determining impairment at the lowest level. Reversals are possible if estimates change. Impairment tests under AASB 136 are mandatory annually for indefinite-lived intangibles. External indicators like market declines or internal factors like asset underperformance highlight potential impairments. Value in use involves forecasting future cash flows and discounting them using a pre-tax rate that reflects current market assessments. Losses initially reduce goodwill, cascading to other assets. Understanding the model and measurement nuances is crucial for compliance. Interviews often probe into AASB 136's nuances. Recognizing external indicators like market shifts prevents oversight. While aligned with IAS 36, local nuances exist. Disclosure requirements are stringent, demanding detailed explanations of impairment tests and reversals. Goodwill requires annual testing, emphasizing precise CGU identification for accuracy. Understanding reversal limitations, ensuring they don't exceed pre-impairment values, is another crucial aspect interviewers focus on. That's her complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to CandiMentor for more accounting and finance videos. We'll see you in the next one.